We've seen a move in the yellow cake market up from $30 when we talked, $40 last year, to currently $75. That the easy money in uranium has been made. That first move where it goes from just absolutely despised to being tolerated is a good move. I believe there's big money ahead, big speculative money ahead. I've sold enough to recover my cost of capital, and also I've sold enough to pay the capital gains tax on the recovery of capital. So I believe the easy money, the money made on the transition from hate, has occurred. I don't own gold because I think it might go from $1,925 to $2,100. I own gold because if things begin to go wrong, it triples and quadruples in price. That's why I own it.
Gold prices remain below $1,950 an ounce, but are seeing a positive start to the week as investors react to Moody's negative outlook on U.S. debt. According to RickRule, president and CEO of Rule Investment Media, I don't own gold because it might go from $1,925 to $2,100. I own gold because if things go wrong, it triples and quadruples. He further talks about the uranium that we've seen a move in the uranium market up from $30 to $40 last year to $75 regarding the stocks, especially the juniors they went from hated to like. The Rule further argues that Kazatomprom and Cameco have large amounts of material they can bring back into production that's already permitted and built. All they need to do is turn the mines on. The structure of the market has changed. They've gone from selling the material in the spot market, where they have no price certainty, to selling it in the term market. We will now bring you clips from RickRule's recent interview with Michelle McCory in Kitco News. Please watch, share, and like this video. Also, ensure you subscribe to the channel and turn on the notifications so you will never miss our uploads. Thanks, and enjoy the video.
I think we, as American dollar savers, face some real issues around debt and deficits. And traditionally, the way that one has hedged oneself against that over time has been gold. I don't own gold because I think it might go from $1,925 to $2,100. I own gold because if things begin to go wrong, it triples and quadruples in price. That's why I own it. The statistic I gave you specifically was, despite the headwinds that I see facing American savers in US dollars, the market share of precious metals and precious metals securities relative to other asset classes in the United States is 0.5%. Put differently, of the total savings and investment assets in the United States, only 0.5% is comprised of precious metals related investments. The 4-decade mean market share of precious metals was 2%. Gold doesn't have to win the war against the US dollar, doesn't have to win the war against bonds. It just has to lose the war less badly. If demand for gold were to revert to the 40-year mean, demand for precious metals in the US market would increase fourfold. And that's precisely what I think is going to happen.
Fourfold in terms of precious metals, increase in terms of physical holdings of we're talking about physical gold, coins and bars.
And gold stocks. JP Morgan Chase estimated that the market share of precious metals and precious metal securities in 1981, at the end of the last bull market, was somewhere between 6 and 7%. I don't need that inflammatory a number for your audience. All I need to say is if we revert to mean, we quadruple demand.
Right.
The price of uranium has risen only slightly since a military coup in Niger last week, as mining operations have continued in the world's 7th largest producer of the radioactive metal. Still, a consultancy said prices may rise in the coming weeks. An event like this could take more time to seep into the market psychology. We could still see bigger impacts in the days and weeks to come, he told Reuters. All indications would be that this would be a catalyst for upward moves in the uranium price, given the overall tight supply-demand balance in uranium at this time. Let's get back to the interview.
The outperformance of uranium relative to the broad market, I actually think that you could buy the Sprott Physical Uranium Trust, SPUT. You could buy the uranium ETF, and perhaps you could add Cameco just for stability and relax. I would be very, very, very surprised if in the 3-year time frame, Cameco itself didn't double or triple. I think increasing their production by 30 or 40%, rather than selling that production at $40 a pound, selling it for $75 a pound, with the visibility of being able to sell at those higher prices for a longer term, will give generalist investors a look at Cameco. When people look at Cameco now, they see a really high price-earnings ratio, and they don't take into account the fact that that price-earnings ratio is trailing based on $40 production before production is up by 50%. I mean, these are important numbers, and they're numbers that are substantiated by term contracts. So there's a very, very high degree of visibility for institutional analysts around earnings going forward. There are geopolitical issues in the sense that after 40 years of relative peace worldwide and increasing cooperation, it would appear that the next 10 years are going to be a little different. And people are scrambling to secure supplies. It will perhaps surprise your viewers to know that despite the tensions between the United States and Russia, U.S. imports of Russian material have doubled in the last 12 months. So despite the fact that we're ostensibly at war, it would seem that lucre overcomes war. Two, with regards to Niger, the French will no longer have below-market access to uranium from Niger. That material will likely go to China. And Canadian and Australian uranium, that now goes to China, will likely go to France. The truth is that we've seen, even with regards to Russian oil, that resources and trade are fungible to a degree, even in times of war. The supply chain issues that will surprise people is that despite an increase in the uranium price from, pick a number, 30 or 40 to 75, you won't see an immediate production response, because you have to find a uranium mine, you have to permit a uranium mine, you have to finance a uranium mine, and you have to build a uranium mine. Other than the supply that can be brought back online from Kazatomprom and Cameco, these higher prices won't lead to an increase in supply for 7 or 8 or 10 years, because you have to permit these things and build them, which is a real challenge. Yeah. The supply chain issues really go to the fact that as a race, humankind, we've underinvested in productive capacity around uranium for 30 years. And now demand is playing catch-up. And we don't have the ability in the near term to address the supply issues.
A blistering bull run is underway in the market for uranium, the radioactive element used to produce nuclear energy. Prices just hit 15-year highs and are on track for a record annual gain, as a move away from fossil fuels increases demand. That's also fueling a scorching rally in the stocks of uranium miners such as Cameco. The Sprott Uranium Miners Exchange Traded Fund, URNM, has jumped 42% this year, higher than the 40% advance in the tech-focused NASDAQ 100 index. Cameco's shares rocketed 83% year-to-date. Uranium is up 55% this year, and last week hit $74.50 per pound, the highest level since 2008. In comparison, gold has gained just 7.7%. While U.S. oil prices fell 3.7%. Demand for the heavy metal has surged as countries from China to India and Russia pursue more nuclear programs to generate more energy while reducing carbon emissions. About 60 nuclear reactors are under construction globally. They will need about 30 million pounds of uranium a year when they start operating, according to a report by mining investment news and analysis provider Crux Investor. On the other hand, uranium supply has been constrained by years of underinvestment in the sector following Japan's 2011 Fukushima nuclear disaster. The widening demand-supply gap will continue to drive uranium prices higher, according to John Ciampaglia, CEO of Sprott Asset Management, which specializes in precious metals and tangible assets. Uranium prices have jumped about 150% in the last 2 years, and we think there's more room to go, he recently told CNBC. Ciampaglia blamed the major supply deficit for the surge. That's a function of having a lost decade where we did not invest in this technology. As a result, we did not invest in a lot of mining. What are your thoughts on RickRule's interview? Please drop your comments in the comment section below. Also, ensure you like this video, subscribe to the channel, and check out our other videos on gold, silver, and other commodities. Thanks for watching.